We've already had a bear market in software, the Mag 7, and in crypto. I think that's already taken out a lot of speculation. Tom Lee. That's how Tom Lee, Wall Street strategist and co-founder of Fundstrat, is looking at this market. Not as overheated, not as irrational, but as something that has already gone through a deep reset. And in markets, that changes everything, because the phase where most people lose money is usually the phase that sets up the next move. At the same time, fear was peaking, prices were collapsing, and confidence in crypto was at its lowest. Today, Bitcoin just broke above $74,000. So the real question isn't just how high it's going, it's whether the speculation has already been flushed out, and what comes next. Because before you celebrate or start texting your friends about Bitcoin's comeback, you need to understand something. What's happening in the market right now is more complicated, more dangerous, and more fascinating than any headline suggests. This video will break it all down, the good, the bad, and the ugly. By the end, you'll understand exactly where Bitcoin stands and what might come next. You have to understand what 2025 looked like going in. The mood was electric. Trump had just won back the White House, promising to make America the crypto capital of the world. Bitcoin ETFs were pulling in billions. Institutions were buying. MicroStrategy, the company led by Michael Saylor, the man who once described Bitcoin as a swarm of cyber hornets serving the goddess of wisdom, feeding on the fire of truth, kept stacking more coins. And analysts? They were falling over themselves with predictions. JP Morgan raised its year-end Bitcoin forecast to $165,000 before the crash. VanEck's digital asset research team called for a first-quarter peak of $180,000, and Samson Mao, CEO of Bitcoin technology company Jan3, went on record in February saying Bitcoin would hit $1 million by the end of 2025. People actually believed it. And for a while, it felt like maybe, just maybe, they weren't crazy. Bitcoin reached a fresh all-time high of $126,198 on October 6, 2025, surpassing its previous peak near $124,500 set in August. Think about that number, $126,000 for a single coin. Not because of hype alone, but because, as Tom Lee argues, markets move higher after excess speculation gets wiped out. Bitcoin didn't just rise, it survived a brutal reset first, and that's what most people miss. Because before Bitcoin reached new highs, the market had already gone through a phase where leverage collapsed, weak hands got forced out, and confidence disappeared. People who bought Bitcoin 5 years earlier at $20,000 were sitting on six-figure gains. Early buyers who got in at $5,000 were millionaires. The believers felt vindicated. But this time, it wasn't just belief. It was a market that had already been cleansed of its excess. And that's exactly the kind of environment Tom Lee says sets up the next move. But that optimism didn't last forever. On October 10, 2025, Bitcoin plunged $12,000, nearly 10% in minutes. The meltdown triggered more than $19 billion in liquidations in just 24 hours. Let that number sit with you. $19 billion, gone, in 24 hours. The crash started when Trump threatened to impose an extra 100% tariff on Chinese imports, on top of the 30% already in place. That spooked traders into dumping risky investments, from stocks to Bitcoin. That's the thing nobody wants to say out loud in the crypto space. Bitcoin, the asset that was supposed to free us from government, banks, and political chaos, was killed by a tweet. One man in the White House made a threat, and $500 billion in crypto market value evaporated. October's crash caught traders off guard and wiped out months of leveraged bullishness in minutes. As one analyst put it, the October 10th flash crash wasn't a failure of Bitcoin, it was a liquidity event, triggered by macro stress, trade war fears, and crowded positioning that exposed how forward-loaded the cycle had become. After that day, Bitcoin never recovered in 2025, it kept bleeding. Then in February 2026, it bled even harder. February delivered close to 15% in losses, mirroring the previous year's February, when Bitcoin dropped by over 17%. With 5 consecutive red months on the books starting from October 2025, the seasonal backdrop offered little comfort. The October 2025 all-time high above $126,000 sat roughly $63,000 above Bitcoin's price levels at the bottom, placing this drawdown alongside some of Bitcoin's most extreme historical corrections, even greater than the selling that took place around the FTX crash. That's not a small drop, 50% from peak. And yet, despite this, many analysts, institutions, and YouTube commentators remained optimistic as prices continued to decline. Now, for years, the 4-year cycle was Bitcoin's Bible. The halving happens. The amount of new Bitcoin created is cut in half, and roughly 12 to 18 months later, Bitcoin hits a new all-time high. Then it crashes. Then it spends 2 years bleeding and building. Then the halving happens again, and the cycle repeats. The halving happened in April 2024, and sure enough, Bitcoin ran. It went from around 60,000, broke 100,000 for the first time in history, then kept rising to $126,000 by October 2025. The cycle seemed to be working like clockwork, but then the crash happened earlier than expected, and the recovery never came. Instead of marching to $150,000, $180,000, or $200,000, as the model said, Bitcoin turned around and fell, hard, and it kept falling. 5 months of red. The cycle people said it shouldn't be happening this way, but it did. What happened, simply put, is that Bitcoin's ideological roots were overtaken by its growing acceptance as an institutional asset. With Wall Street's involvement, Bitcoin became more closely tied to macroeconomic events that impact all asset classes. That's the trade-off nobody fully understood. When BlackRock, JP Morgan, and Fidelity enter your market, they bring capital, but also correlation. Now, when the S&P 500 sneezes, Bitcoin catches a cold. As of early March 2026, the 30-day rolling correlation between Bitcoin and the S&P 500 stood at 0.55. Meanwhile, gold and silver continued to surge while Bitcoin bled. The asset that Rick Falkving once said would do to banks what email did to the postal industry was now moving in lockstep with the very system it was supposed to replace. This situation highlights a significant irony. Now, let's bring it to the present. March 2026. As of March 16, 2026, Bitcoin is trading at $73,882.25, about $8,700 lower than it was 1 year ago. After bottoming out near $63,000 in early February, Bitcoin has been grinding higher. 7 consecutive daily green candles, a bounce that's brought it back to the $74,000 resistance zone, and the crypto Twitter community is split right down the middle. On one side, you have Ash Crypto pointing out that Bitcoin just printed 7 consecutive daily green candles, and that the last time this happened was right after the April 2025 bottom. He's saying this looks like a floor, a recovery, a new leg up beginning. On the other side, you have analysts like Clark, who posted just days ago with a very different read. He says the 40-day range is finally nearing its end, and not in a good way. His thesis, the $74,000 sweep was a fractal, a fake-out, a bull trap designed to pull retail buyers in before the next leg down. He calls the next sequence, distribution, drop to $70,000, consolidation, then an impulsive move down to $60,000, and then you have Ted Pillows, who is watching the same chart and saying Bitcoin is now entering a heavy resistance zone between $75,000 and $76,000, which also happens to be the average entry price for Michael Saylor's massive Bitcoin position. His view, the ideal scenario for Bitcoin is a fake-out above $76,000, similar to what happened in January 2026, before dumping back below $60,000, so you have two forces colliding at $74,000, the bulls who believe the bottom is in, and the bears who believe this bounce is a setup for more pain. It's important to clearly acknowledge the risks, as people deserve transparency. Bitcoin's high correlation with software stocks weakens its case as a hedge asset in times of uncertainty, and as Trump continues to elevate economic uncertainty, Bitcoin's continued weakness should be expected, according to Kevin Crowther, founder of KC Private Wealth. There's also the macro picture. The Federal Reserve hasn't cut rates anywhere near as aggressively as markets hoped. Tariff tensions are still alive, equities are shaky, and Bitcoin, for all its ideological promises, is now a risk-on asset in the eyes of most institutional money. When those institutions get scared, they sell Bitcoin first and ask questions later. Look at what happened in October. Look at February. The pattern is clear. Anytime macro stress spikes, Bitcoin gets sold hard and fast. And right now, macro stress is not going away. There's also the technical problem. Bitcoin is sitting right under a major resistance zone. If it fails to convincingly break through $75,000 to $76,000, the bear case looks very strong. Sellers who bought near the all-time high are sitting at a loss. They're watching this bounce. They're looking for an exit. And once they start selling, it creates pressure. Pressure creates fear. Fear creates more selling. According to Crypto Quant Analysis, large holders who bought near the $126,000 top were forced to realize massive losses, creating sustained selling pressure that initially knocked Bitcoin down 32%. Those wallets are still out there. They're not all gone. Some of those people will sell into any strength they get. The cycle may not be over, but it appears to be stretched and changing in ways that challenge traditional models. That in itself presents potential risks. But here's the thing. Here's what the bear crowd keeps missing. Every time in Bitcoin's history, every single time, the people who called it dead were wrong. Bitcoin has survived more death pronouncements than any asset in human history. It survived China's ban. It survived multiple exchange collapses. It survived the FTX implosion in 2022, which sent it crashing from $60,000 to under $16,000. And every time it came back. But Tom Lee looks at it through the lens of market behavior. And this is how he describes moments like this. We should be pretty close because sentiment is terrible. The price action's been bad. He's not talking about hype. He's not talking about ideology. He's talking about timing. Because in markets, the moments that feel the worst are often the moments closest to a turning point. When sentiment collapses, when price action breaks down, when confidence disappears, that's usually not the end. That's the setup. A monetary network that no single government can shut down. An asset with a hard cap of 21 million coins that no central bank can inflate away. A system that keeps running, block by block, every 10 minutes, whether the price is $10,000, or $126,000, or $60,000. Also, Jack Dorsey, the co-founder of Twitter and creator of the payments company Block, once said, "The internet will have a native currency. I believe it will be Bitcoin." He said that, then put his money and his company behind it. And right now, even in this downturn, that thesis hasn't been disproven. Bitcoin is still the internet's hardest, most liquid, most decentralized monetary asset. Nothing has replaced it. Nothing has come close. Long-term holders, wallets that have held Bitcoin for 365 days or more, are a critical group for gauging market direction. Throughout February 2026, their net selling collapsed from 243,737 Bitcoin in early February to just 31,987 Bitcoin by March, an 87% reduction. Miner selling also eased sharply, suggesting the worst of capitulation may be behind us. The hands that were going to sell have mostly sold. What's left are the people who bought and buried it, the people who don't check the price every hour. The people who understood the bet they were making when they got in. Those people aren't selling. And then there's Michael Saylor. Whatever you think of the man, you cannot ignore what he's done. Through every crash, every doubt, every 5 consecutive red months, Saylor and his company, Strategy, kept buying. It won't be sold when Twitter gets bearish. It won't be sold when a pundit says it's over. The Saylor bet is a long, long bet, priced in decades, not months. He described Bitcoin as a swarm of cyber hornets serving the goddess of wisdom, feeding on the fire of truth, exponentially growing ever smarter, faster, and stronger behind a wall of encrypted energy. That quote sounds insane. Until you look at the network's uptime, it has been basically perfect since 2009. Until you see the hash rate, the computing power securing the network, at all-time highs, even as the price struggles. Until you remember that Bitcoin has turned every bear into a buyer, given enough time. So where does this leave us? Bitcoin is at $74,000. It's under heavy resistance. The macro environment is hostile. Bears are calling for $60,000 or lower. The 4-year cycle looks wobbly at best, and the same asset that hit $126,000 5 months ago is sitting 40% below that level today. But here's the truth, the uncomfortable, complicated, honest truth. Nobody knows what comes next. Not Clark, Not Ted Pillows, not Ash Crypto, not the analysts at JP Morgan who said $165,000. The history of Bitcoin is littered with brilliant people who were completely wrong about what happened next. What we do know is this: the people who bet against Bitcoin's existence have always been wrong. Again and again, it was dismissed, called a bubble, written off as a passing trend, and yet, Bitcoin outlasted every wave of skepticism thrown at it. The asset that many believed would collapse now has a market cap of over $1 trillion and is held by sovereign wealth funds, pension funds, public companies, and even governments. What we also know is that the next few weeks around this $74,000 to $76,000 range will be among the most important Bitcoin has faced in this cycle. It either breaks through and changes the narrative, or it gets rejected, and the bear scenario plays out towards $60,000. The bounce from $63,000 to $74,000 is real. 7 consecutive green daily candles are real, but so is the resistance overhead. So are the macro risks. So are the people waiting to sell into this strength. Rick Falkving said Bitcoin would do to banks what email did to the postal industry. Email didn't kill the post office overnight. It took years. And there were moments along the way where people thought email was just a fad, just a toy, just a mirage. Then one day, they looked up and found the post office irrelevant. Bitcoin might be in one of those messy, confusing middle chapters right now. The chapter where the story isn't clean, where the bulls are nervous and the bears are loud, where nobody rings a bell at the bottom or the top. But the chapter isn't over. It never has been. So watch this zone. Watch $74,000. Watch $76,000. Watch whether the volume confirms this move or exposes it as a fake. And whatever you do, don't make financial decisions based on the loudest voice in the room, because in this market, the loudest voices have almost always been wrong. Thanks for watching, and don't forget to like and subscribe. See you in our next video.